Let's take a look at some of those earnings reports that were out, starting off with Equity Bank. The numbers there coming in after the closing bell. What did you make of those numbers?
From the results of Equity and NIC Bank, actually, we're able to tell that now the true effect of how the economy is actually coming out, because you can actually see that Equity reported a pre-tax loss of 15% in its in the aspect of profits. Its increased operations actually were up 23%. So basically, these are the few indicators we're looking at to be able to understand how companies, especially in the finance sector, have been doing, because for the last 1.5 years, they've been the best performing companies when all the sectors are put together. When you look at NAC, there was actually a growth in its pre-tax profits by 23.4%. So it's actually hard to tell how the strategies in various banks, because you see, like, Equity has taken the approach of actually targeting the mass market. NIC Capital has taken the path of looking at corporate and the equity market. So the different strategies applied by these banks can actually reflect how the results are going to be. Yeah. We're still looking forward to more, and then we'll be able actually to tell how things will be. But from the way the various macro fundamental factors of this country are, I don't think we'll be having good results anytime soon.
Just looking at Equity's numbers, I mean, they've attributed the losses to a once-off income of an estimated 1.1 billion Kenyan shillings from the Safaricom IPO, which it earned last year. It's also said that operating expenses have increased 32%, and that partly due to the aggressive expansion plans they've embarked on. But the concern really comes from the fact that Equity doubled their reserves, provisioning for bad debt at this stage of the game, and that really eating into profits. Just how concerned is the market with that level of provisioning?
We can actually see that finally, at least, it's the one bank that actually admitted the Safaricom was actually, the Safaricom IPO was not such a beautiful, dessert on the table as many people thought it will be, because now everyone seems to be actually turning to Safaricom and saying, we're incurring these losses, we're having this increase in expenses because of Safaricom, or how we went about it. But the provision given by Equity is actually worrying, because I believe it's not the only bank that actually had such a particular trend, and now we'll be looking at the other IPO transactions that actually took place, and we'll be asking ourselves, are most banks going actually to have a thing with the IPO transaction saying that this is happened because of what happened in the stock market? But I believe in as much as banks have actually taken into the equities market strongly, it's time the banking industry actually separated itself from the equity and the stock market, because with this, we'll be able to know in terms of bookkeeping and the financial records how things are, and for us investors can actually help us to know which way to go in terms of investing at the market.
Steve, just looking at the numbers here, I mean, the ratio of net non-performing loans to net loans and advances worsened to 5.3% from 3.2% in June 2008. I mean, given this and given the level of provisioning that's been made, what does this say about the bank's risk mitigating or management strategy, especially in the current climate, and especially given the fact that its major target is the mass market?
I believe, especially with Equity's strategy of actually going for the mass market, I think they need to relook at it in the current economic situation, because even as we speak right now, most SMEs, businesses in this country, are actually really suffering a lot because of water shortage, electricity rationing, and the like. So most of these people who had actually borrowed loans from say Equity or Kenya Commercial Bank or NIC will actually, I'm thinking, will be going back to the management and saying, let's renegotiate our loan, give us more time to repay this. And then the other thing that actually been in the headlines is the aspect of the lending rates. When you look at it, the deal between banks and central bank, and then between commercial banks and clients in terms of lending rates, there's a big disparity in terms of how much we as clients actually pay. So when you see there's the aspect of what's happening in terms of economic fundamentals, and then there's the basic management in terms of how loans are repaid. So I think banks are actually going to sit down and relook at how they're going to lend the loans. And 2 weeks ago, actually, Central Bank did ask the banks to actually relax on the terms and conditions when they're actually giving out money. Yeah. So I think there'll be more provisions on bad debts, on non-performing aspects in the books for, say, the next 2 quarters.
Well, the CBK is certainly hoping that its new policies will lead to faster rates of expansion. It's already lowered its own lending rate and the cash reserve ratio for banks to 4.5% from 5% in order to inject more liquidity into the economy. Many saying, given that scenario and given the fact that we've started to factor in some kind of an economic growth story for Kenya in the second quarter of this year, that Equity Bank is the stock to buy ahead of that GDP rebound. What's your view?
One, whatever comes out of central bank, especially its monetary policy committee, has little or no effect at all on how banks actually do their business, because over the years, when you look at the aspect of rates between banks and central bank and then banks and clients, it's actually a very big disparity. And secondly, when central bank actually asks banks to relax on the lending terms, I'm thinking, if I was a bank manager, I like to give out my money knowing that I'm actually going to get it back, so that I hold on to my money until conditions become favorable. So I believe the terms and conditions that central bank is actually hoping to change the market and hope for spine in terms of growth will actually have little or no effect at all, at least in the next 1 quarter, because right now banks are actually trying to handle the bad debts, non-performing loans, and not trying to look at the bottom line. That will be actually the key fundamental driving force behind how banks will relate to their clients.